Thank you for watching Junior Mining Talks. My name is Antonio, and I hope you're having a great day. And if you're not, well, then you might want to watch something else that's not junior mining related, because my therapist says the sector is anxiety inducing, but she just doesn't get it. Now, if you do stick around, we'll be talking about the differences between the Canadian stock exchanges and Australian stock exchanges, with the idea of figuring out which one has the lower, though not low, but the lower chance of losing you money. Before we start getting into the actual conversation here, though, I would like to warn everyone listening and watching that we have not received monetary compensation for the production of this video from anybody. However, you still need to understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research. Research is conducted by reading official company filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, neither is Luke. So before continuing on, please do talk to an investment advisor with a good long-term track record, because your capital is at risk. And we are neither licensed financial advisors, nor do I personally have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers that I just showed on your screen, please go to the last section of this video and do not consume this content unless you fully understand and agreed with everything said herein. That all said, joining me on Junior Mining Talks today is Luke Den Haven, as always, and Mark Bennett, who's not only played the game for a while now on both sides, I think, of the globe, but he's also won the game a few times, I believe, and probably lost the game just as many times. So there's battle scars there to talk about as well. So, Mark, I'm looking forward to this conversation, and I thank you for being here.
Yeah, thanks, Antonio. Thanks, Luke.
Well, the pleasure of mine. We spoke like about a month ago, and I thought it was at least 6 months ago. So time flies when you're having fun, I guess. But briefly, which exchange has a better level playing field, in your opinion, for retail investors? Because that's something we get complaints on. Well, not complaints, but people comment on these videos like, oh, the Canadian markets they're totally messed up. You have to be an insider. Nobody makes money on the Canadian markets except insiders and brokers. First of all, do you think that's true? And second of all, is it better in Australia?
Look, I don't think it's really true, and it's probably similar in Australia as well in that regard. I think retail investors will always feel that they're hard done to compared to instos or sophisticated investors who get to participate in discounted placements and things like that. So not so much insiders. I think the restrictions on insiders on the ASX actually prohibit them from being in a position of advantage more than anything. But slight differences, but pretty well even.
Well, when you see how does that work on the Australian stock exchange, like buying in the open market? I know it's different in the US. Do you have to file for it, I assume, but do you have to wait for 2 weeks after material news, or like how does that work?
There's sort of guidelines, and most companies have similar procedures. So, from the point of view of insiders, there's usually an embargo for a couple of weeks, a blackout period before quarterlies and half yearlies and yearlies and things like that. And obviously, if there's any undisclosed material information, no one can buy, and it's very strictly enforced as well. But pretty well, the moment something's out on any platform now, insiders can participate on market.
If you look at Canadian markets, people really track insider purchases. I mean, people are following CDI through various sites, and they can follow, big investors, but also CEOs and other people in the company buying and selling stock. Is that a thing in Australia too, where people really find it important?
Yeah, they do. And, as part of the routine compliance stuff, any insiders trading, buying or selling, have to lodge what's called a 3Y on the ASX within 5 business days of any trade. So it's deliberately made very transparent, and people do watch those things. And, as a sort of barometer of insider sentiment, they they'll usually take that as a lead one way or the other.
Is it 10% as well? Who has to file for? When are you an insider in Australia?
Yeah, it's basically anyone considered to be on the board or key management personnel, KMPs. If they're in a position to influence the company, then they're considered insiders. So it's actually quite strictly enforced, and I actually quite like it. It's as transparent as it can be. I find the Canadian side can be a bit murky sometimes.
How do you mean?
Just in terms of who's deemed an insider and therefore who has to disclose what they're doing. The definition just seems a bit looser.
Well, but what if I own 15% or something of an Australian junior? Am I an insider?
You're not an insider, but you're a substantial holder. So the moment you go over 5% holding, you have to disclose that. And if you change your percentage ownership, you have to disclose it in real time as well. So the whole market can see if there's a key player accumulating or doing the opposite.
Is it do you have to report that within a week, or what's the period for just a substantial owner not being part of the company? Is that also a week like in Canada?
Yeah, it's generally 5 business days. Yeah.
How is it that how are executive teams different from the perspective of behavior and talking about promotion and how much time they spend in the field? That's a question that I typically ask when I interview CEOs as well. Are you going to the field this season? Is it something that happens a lot? Do they spend more time in office? How's kind of the executive culture, I guess, is what I'm asking here.
Yeah, it's quite different. The culture's quite different in a number of ways, but in terms of investor relations type things, most Aussies, when they go to PDAC, they're fairly amazed by the fact that pretty well every company has a full-time IR person on the booth there, because that's not the case in Australia. With the bigger companies, yeah, sure, they have full-time IR people and even departments, but at the junior end, it's done really on a third-party basis. Some companies will engage sort of one-stop shops to do marketing, IR, PR for them, but it's nowhere near as ingrained in the culture as it is in Canada.
How does it differ from a compensation perspective in that case? I mean, if they have to wear more hats, essentially, do they get paid more? And then I also want to ask you about the type of compensation, as in, is it typically cash heavy, or do they get more shares, like equity heavy?
Yeah. So I've never done a comparison of sort of remuneration for execs in Australia or Canada, but typically in Australia, if you're in an executive role on the board or not, you generally don't get to go on to too many other boards. It's quite different. If you appear on too many boards, it's seen very much as a negative by the investment community that your time is spread too thinly and your loyalties are too divided. So, a managing director or a CEO of a junior explorer in Australia may have one other non-exec position or something like that, but generally that's their job. And again, it's quite different to the Canadian scene, where you often get incubator companies that have 3, 4, 5 spin outs sitting under that umbrella, and there'll be similar directors on multiple boards. It's not seen as a sort of positive thing in Australia, particularly by institutional shareholders as well, not so much retail.
And in terms of option packages, do people get big? I have the impression that option packages are bigger in Australia, and you don't see as many warrants, but you see options, right? Is that a big compensation factor?
Yeah, and I mean, we can get onto warrants because they essentially don't exist in Oz, but option packages for execs, for employees, and for service providers, consultants, and so on, are generally bigger. And obviously, the smaller the company, the less cash there is to go around. So you don't want to be using it all paying everyone's salaries. You'd rather pay people less and have them more leverage to success. And there's a bit of variation in that depending on particular companies and particular people's circumstances. But if you're a CEO of a junior exploration company, you in Aussie dollars you'll be getting paid something between $200,000 or $300,000 maybe. The option package will be enough to be a lot more meaningful. Sorry, I got a couple of dogs barking here. Hey.
They want to say something too. They feel like they
Yeah,
thought that was not right. They're like 200 grand. That's not enough. They want 400. So you're saying 200 grand. That's actually something that I did want to ask. That's what 175 Canadian. Yeah. That's what it is. Yeah. Who makes more money? Like, do CEOs make more money? All in all, like total comp, bottom line. Do Aussie CEOs make more money? Do Canadian CEOs make more money?
Good question. In Australia, because I guess a lot of people are leveraged to the options, in the case of success, they can make a lot of money. But that's probably the exception rather than the rule.
So does that mean that Aussie CEOs are more incentivized to push for success?
Yeah, I believe so. We've got a whole spectrum of companies here, probably the same in Canada as well, from the serious guys to the lifestylers. And there are some companies and CEOs who've been around for 30, 40 years who just managed to subsist for a long period without having a lot of success. And there's at the other end of the scale, there's people who are hungry for success, and it's you can spot them a mile off, put it that way.
How do you do that? What are you looking for?
You're looking for how much money they're putting in the ground rather than spending on overheads. The longer you are around for and the less exploration you do just to spread the dollars over a longer period of time just to pay your wage, then the less successful you're going to be, because pretty well, your success is based on how many holes you drop, ultimately, if you want to be simplistically about it. So you've got to be prepared to spend it. And that's one thing we did with Sirius. We actually, at the start, and unusually said, we'll raise 10 million bucks, we'll give ourselves 3 years, and we'll do or die trying. And we found Nova in 2 years and 11 months. And the last bit of cash. And that was, in part, I think that success was because that's what we did. We put the money in the ground. If we'd have been fearful of running out of money and wanting to preserve our jobs for the next couple of years, then we might not have put that money into those holes, and we'd have been around for a lot longer but achieved a lot less.
Yeah, what would have happened if you didn't hit in that hole? Would you have abandoned the project?
There was a broker sort of sensing blood in the water, sensing we were running out of money, who was going to offer us a rescue deal, but it would have been deeply discounted, highly dilutive, and more in their favour than the existing shareholders. So we resisted the temptation of that, and really because of that, when we were successful, the share price was a lot less elastic because the capital structure was still relatively tight. So we'd have been successful either way, probably, but the benefit would have been halved.
But if you didn't hit, I mean, this is really the game, and you're saying that people are taking more risk. They accept taking the risk in terms of, if it fails and you walk and you only have one project, then the company is essentially an empty shell, right? So you would probably lose a lot of market value, which is then in a way accepted by the strategy. But what would have been the next step? Would that have been like looking for new projects, or just I mean, what would have been the next step if you really failed on that project?
It would, without that, it would have been, hibernation, regeneration mode, looking for new projects, and to fund that, there would be some sort of capital raising that would have been highly dilutive. So we'd have lived to fight another day, but on a lot less favourable terms for our shareholders.
Yeah, because at the time, I think the company went from 5 million to 500 million in a really short time. But if you would have missed, the 5 million would have been a $2 million market cap or something, and then you raise money at that valuation, and that's the new base to work from, basically. So it's not that you give up the company, but people lose 50% and you start over again, let's say. That's the game.
Yeah, absolutely. And when you get to those levels, you're essentially a shell. So you're deemed a target for somebody else to come in and take over and do other things with. So the company would have continued, but I wouldn't.
Would it have happened the same way if it was in Canada, though? Because I'm thinking culturally, are Australians quicker to kind of drill the kill than Canadians?
Yeah, I think so. I think it's all about drilling in Australia, and you can put out news of geophysics or geochemistry or anything else, and no one really cares about that. It's only drill hole results that move the market in Australia. And because other than a few small spots, there aren't any restrictions on field seasons, drilling is a year-round activity. So it's the sort of bread and butter compared to, Canada and some other places where you were restricted by field seasons. So the market is desensitized to that. It's more accepting of periods where news flow will be restricted because of not being able to get into somewhere, I think.
What about putting out a news release where you're saying we're going to the conference? Is that something Australians do?
No, not by and large. There might be one or two, but conferences are just a means to an end. They're not an end in themselves.
Exactly. And I mean, there's a lot of things that get news released that sometimes I look at them and I think, like, why is this a news release in Canada? Now, to go back to the topic, though, here, Mark, Luke and I have been talking about this, kind of going back and forth about what's kind of the proper way to do the exploration business within the topic of drill to kill or not. And do you really go and just drill, essentially? What do you think? I mean, is that the right approach? Go and drill a target, or take it kind of step by step, collect more data and wait for better markets and so
on? Yeah, there's a whole spectrum of companies doing different sorts of things with different sets of shareholders with different aims, I think. So, you can get the companies that want to take on an old project, spruce it up a bit and double its value and on-sell it, for example, which is fine. There's a niche for that. There's companies like ourselves who are essentially like exploration divisions of bigger companies that want to do proper exploration and go out and find big things, which takes longer and is more systematic and higher risk. There are companies who their modus operandi is to drill in well-known areas, so in the shadow of a head frame, and find a new resource. There have been some good examples of really good success with that. It's not just drilling a director's special beneath old workings or something like that. They've actually found a new deposit close to some tired old stuff. So I think what happens, it's sort of self-organizing in that the different companies go about it a different way with different objectives, and they attract different sets of shareholders. So shareholders of S2 are in it for what we do, and they wouldn't reward us for going to drill underneath some old workings and coming up with a few hits that are sort of quick sugar hits to move the market temporarily. They're more sort of fundamental than that. But there are other companies that do stuff equally as valid, which is exactly that, and people make money on it, which is what it's about.
Yeah, most really big successes, if you look at share price performance, is when a company has one project, they focus on that one, they make a discovery, and then everybody wants to own that company. But in a way, I mean, I'm an investor myself, and I look at many of these juniors, and these things are so risky in most cases because it's really one or two targets. If they miss, then it's game over and they have to start over again. S2 is a bit different, I think, because I wouldn't describe you as a prospect generator, but you do have several projects. So if one fails, it's not that the complete company is done. Is that a thing is that also a reason that you have multiple projects right now? Or is it just like a result of you being well known in the market, being able to do more deals, having Creasy behind you? I mean, what's the reason of having more projects? Is that to also protect the shareholders a bit? I mean, because it's lower risk in my opinion. It will not kill the company if there's one drill program that fails, so to say.
Yeah. Look, it's a conscious thing, and I think there are two main drivers for it. One is the fact that when we explore, we don't want to over drill it. We've seen a number of companies fall in love with projects and just keep on banging their head against a wall with them, with diminishing returns. And our way of doing things is almost the opposite of that. We have a particular idea that we test, and if we don't get sufficient encouragement, then we move on. So in order to replenish that pipeline, we always need a good sort of portfolio of projects of different sorts and at different stages to be continually sort of moving forwards, if you like. Now, if we're successful at one, then obviously everything changes and you sort of go down a different path. But the other reason is land access, which is a big issue in Australia. It can take quite a lot of negotiation and time and money to actually get on the ground to explore, whether that's through negotiating with First Nations or private landowners or stuff like that. And you can't rush that stuff. And if you've only got one project and there's a problem, then you're suddenly starved of doing anything and any news flow. And you don't want to be in that position. So you want to have a number of irons in the fire with something happening somewhere at any one time. And that's why we do it consciously.
Is it also how you finance? I mean, the moment you have all kinds of things lined up and you have a busy year ahead, is that when you reach out to a broker, or do you typically talk to your shareholders first? I mean, I see a lot of these broker deals. I mean, they don't call them broker deals, I think, but where somebody takes care of your financing, or is there a lot of non-brokered as well, where people just have their own network and raise money from their own network?
Yeah, it's mainly, and again, financing in Aussie is very different. Most companies usually go down the private placement path when they want to finance themselves. So, they'll be mandated to a broker, but it's all very quick. So a typical placement, you go into a trading halt for 2 days, fill the book, and then come out of the halt after 2 days with the money in the bag. There's none of this sort of financings being open for weeks or months at a time. So that's the most common mechanism for funding it. There are rights issues, share purchase plans, things like that. But most people prefer not to do that because it means you're open to market risk for best part of 2 months whilst those processes happen. And on one hand, they're better because they're more egalitarian for all shareholders, I guess. But it does expose you to risk. So depending on your view on what the market risk is and how long you want to be exposed to that versus whether you want every shareholder to have equal dibs at an opportunity to participate, or whether you're trying to design your share register and bring particular players in to increase the quality, it sort of steers you down slightly different paths.
Can you describe that in a bit more detail? When you think like it's becoming time to raise money because you don't want to go too far, but you didn't reach out from someone to finance you, and you say, hey, it just takes 2 days. I mean, at what point are you first gauging interest a lot? Are you going to several brokers? I mean, what's the process from the moment you realize, hey, we are getting close to doing a financing? What is your first step? Is it calling a broker? How do you start the process and how does it end really? Because you said 2 days, but I can imagine you also need to reach out to a few people to find out if there's interest in the first place.
Yeah, and it's a really really delicate dance because you don't want to alert the market too much of your intent. You always want to take the market by surprise with the capital raise, so you don't want to signal it. And the more people you sound about it, the greater the risk of word getting around. And likewise, if you're running out of money and you'll come issue, the same thing will happen. People will sense there's an opportunity, and you'll get selling pressure. The share price will go down, and your cost of capital will go up. So you're on the back foot immediately. It's really a process of, I guess, through relationships with key shareholders, sensing what their views are and getting a feel for the market in general as well. And you don't sort of, what we do is, and what most sensible companies do is if they're looking at raising money, they'll sort of backwards engineer their work program to create the momentum leading up to that point in time, so that they can do everything that's in their power to make it as favourable as possible. Now, you never know what the results are going to be of what you do, but the more you're doing, the more momentum you have, and the more favourable the terms you can raise money on generally. There are companies that don't seem to get that, and they just sort of stumble along and drill something and suddenly realise they've got no money and go sort of cap in hand begging for more, which obviously is to the advantage of the brokers rather than them and rather than the existing shareholders. So, it's having a good dialogue with key shareholders. It's just watching the market, and it's just having a sort of, as much as you can, a sixth sense as to when the time is right. And often you might have a strategy with a particular time in mind for raising money, but as with all strategies, they can go out the window 5 months after starting them, and you end up being tactical instead. So you just monitor everything you can, and when the time's right, you just sense it, and it's almost an instantaneous thing. And if you've done the groundwork with your relationships, then the people you need on your side are ready to go.
Well, this ties nicely into what we were talking about before. It's like drill or wait. So let's maybe put it into an example. Like if you had $1.5 million in a copper porphyry explorco, you're looking for deep stuff in, say, Argentina, high up in the Andes, where it's $1,000 a meter to drill, and you need to drill a kilometer deep hole. And at the same time, your G&A was like $100,000 a month too. Would you drill that $1 million hole and know that you have to raise after the program, irrespective of what the grades are going to be? Or would you push to live another year, because that $1.5 million gets you at 15 months in the future, and kind of hope for a different market to take you higher, then raise and then drill if there's more interest? Like what do you do in that situation?
Yeah, that's why one of the most stupid things in the world is to be a CEO of a junior explorer, I think. Yeah, that's a really hard question, and it's the sort of thing that a lot of people face on a regular basis. And there's pros and cons to both, really. If you're too defensive, you can be accused of missing an opportunity or being a lifestyler. If you're too aggressive and you're wrong, you might not get a second chance. So I think, again, in part, it depends on the alignment of your shareholders. If the key shareholders are of a like mind and prepared to go high risk, high reward, then it will steer you one way. If your key shareholders are, counselling caution, it'll steer you another way. So, you don't manage the company in isolation from who actually owns it, which is the shareholders. Sometimes management forgets that they don't own the company; it's the shareholders. So, if you've got a register that is gung ho and all for high risk, high reward, then you might take a chance and roll the dice. But the responsible approach is a degree of caution. And, if there's a middle ground, then usually that's probably the most sensible path to take. Not necessarily drill that hole instantly, but do all you can to try and minimise the risk of that hole whilst not breaking the budget.
So essentially, you want Luke as a shareholder, not me. Got it. This is also maybe kind of a tricky question because there's another answer to it, and that was you go for a JV. That happens a lot in Canada. I think it's different in Australia where you do asset level dilution, where you give away some of the asset level upside. A major earns into 75% or whatever it might be. Is that something you would consider in that situation? Thinking like, we have a million and a half. What I'm going to do is I'm going to spend $1 million traveling around the world, meeting all the majors and looking for a JV so that we can actually do more than 1 kilometer deep exploration program.
I think in that case, I wouldn't be comfortable spending most of that money traveling around looking for a partner, because I think the partners would sense that, and again, you'd be at a disadvantage. I would spend it more on sexing up the project and getting them to come to us.
That's what is, but when you have $1.5 million, how do you do that though? Because again, the only thing you can do is drill one hole, and you cannot sexy it up if there's no grade.
Yeah. In that particular example, yeah, tricky to. In that example, if you got one hole in the Andes, then you might go around looking for partners, but I certainly wouldn't want to be spending $1 million doing that.
I think it's tricky, right? Because sometimes you could be very close to it, and like you can think, oh, this one hole is gonna kill it, but maybe the project is not killed. You drilled it in the wrong direction, or you drilled it in the wrong spot, or something like that. So that really is the tricky part. I guess there's no one solution to it.
No, there isn't. I think it's best to, in that case, I think conserve your treasury and live to fight another day. Sometimes it's best to do that. And as you say, you might drill a hole and it's not either a hit or a miss. It's something in between. It's something ambiguous, which leaves you in an even worse position, actually. And my old boss used to have a saying. He used to say, drill enough to find something, not enough to make sure you've missed something. And that's the sort of principle we try and live by, which means you can walk away and miss things, but at least you do live to fight another day and have another go.
When you look at the average Canadian presentation, you typically see the management team first, and then you see the share structure, and then they highlight if they don't have many warrants outstanding, that they have a good share structure. And after 6, 7, 8 pages, you get to the project. And in Australia, you see a little bit of the opposite, where you see the project, and sometimes you see a bit about the team. Is a team important? Do you want to have a salesperson, or do you want to have a geologist running it? Or maybe not you want it, but maybe investors that you meet, do they really care who's running the company, and are they looking for share structure, or they don't really care about it? They just want to have a shot at the discovery.
Yeah, that's a good one, actually. So in terms of people who run junior companies, you can get geologists, and often they're pretty clueless commercially and don't speak the same language as the finance guys. Or you can get finance guys or promoters who do speak the same language, but don't necessarily know whether their assets are fundamentally any good or not, and they're reliant on whoever they employ to advise them. And it can be a fatal sort of weakness in the chain. So ideally, you want somebody who's a bit of a jack of all trades, but there aren't many of those around. And yet, I think most people I know who invest in this space prefer to back the jockey rather than the horse. So they're more interested in the team than a particular asset, because if the team has a track record of success, then at this particular point in time, they might not be on a winner, but they've got a much better chance of finding one and making it a winner when they do. So management teams are pretty important. I think they're less worried about share structure, because fundamentally, if you find something and develop something that's that's robust, the shares will respond regardless. And there's this sort of Canadians get a bit freaked out by the number of shares on issue with some Australian companies, but it's still the same market cap at the end of the day. Whether you've got 1 billion shares or 100 million at a different value, if the market cap's going to be the same. So they're not as worried about that. One thing that bothers me a lot is in presentations, when I see that sort of IR overkill, and particularly when companies spend the first third of the presentation talking about the market or the commodity, to me that's complete a red flag, because the people who spend their entire careers analysing markets or commodities don't get it right. So how a junior explorer CEO can have some sort of insight, God only knows. So you have to focus on what you can control, what's in your circle of concern, if you like, which is what you're looking for, basically what ground you've got, whether you've got the money to explore it, and whether you've got the good people to spend the money wisely. We don't worry about what a particular commodity price is doing or what markets are favouring particular commodities in the future, because a good discovery is a good discovery regardless of what it is. And we don't worry about cycles either. We don't switch from one metal to another just because one's running hot, because by the time you find something and particularly develop it, it's going to have gone through a cycle or two anyway. So as long as what you find is robust enough to be lowest quartile in whatever it is, who cares?
Yeah, I find it interesting that you mentioned the betting on the jockey, because I think that's for sure a Canadian thing, and perhaps an Australian thing too. If you look at high caliber management teams, or maybe high caliber investors or backers, I mean, in Canada, you probably have about maybe 10, maybe 15, but names that everybody knows, like Eric Sprott and the Lundin family and Pierre Lassonde, Ross Beatty. And when those people get involved, then typically there's a whole following jumping in as well. Is there can you mention a couple of names in Australia that are not really North American names, where people would really jump in because of the name, or is that not really a thing as much?
Yeah, it's definitely not as much of a thing in Australia. It's a smaller pond. There are fewer sort of personalities. So it's really, I think, investors back the management teams and particular managers rather than investors as such. One exception is, for example, if Mark Creasy gets involved in something, then a lot of people will assume it's got to be good and follow suit. But there's no more rational basis for it than that. Whereas I think in Canada, you've got a number of those names who've had past successes and money follows them. But some of those past successes disappear into the rear view mirror, and some of the investments that those guys make aren't so good either. So and I'm sure there are players as well who use their name to get in with the intent of getting everybody else in, and then they get out.
Yeah, in terms of the big names, that's more difficult when they get really above 10%. But for the people who can get diluted below 10%, of course, that could be a reason. What about management teams then? How many? And of course, we cannot really statistically get the right number here, but are there like 10 teams or 20 teams that have a big credibility level? I remember when Chalice made the discovery, and I'm not really familiar with all the different networks in Australia, but when I saw the people behind Chalice, I thought, okay, this is probably a real discovery. This is not just a promote or a company saying like, hey, we found something, but it was just a re-drill, an old hole or something when they drilled this nickel PGE discovery in 2020. So I would consider that probably a group of people that is seen as credible. Are there 10 groups like this, or 20, or are there like multiples of that in your mind?
There's probably, I don't know, between 10 and 20. There's, the obvious names, the sort of billionaire investors. Tim Goyder was behind Chalice, for example. there's Gina Reinhardt, Twiggy, Andrew Forrest, those guys. They sort of attract a following. Then there's sort of sets of serial entrepreneurial managers, if you like, who will buy and sell things and sort of move through the market that way. And there's probably 5 or 6 groups of those. There are some management teams like what used to be Regis who were renowned for sort of taking ultra low grade gold mines that no one had touched and making them hugely profitable through efficiencies and so on. So there's a number of different sort of subcategories in there, if you like. But there doesn't tend to be the big name sort of investors like the Sprots and so on who you have in Canada.
Australians will i.e. everything. Like the man's a billionaire, and you call him Twiggy. We don't call Eric Sprott Sprotty, which I think will get some people mad here. But it's where do you see a stronger market reaction to discoveries then in that case is what I'm thinking here, because Luke's going to need a minute here. With Sprotty got him really good. Lukey.
That's a good one.
Yeah.
I like it.
Would you call Luke Lukey?
Well, people call me not every day, but it happens. I mean, recently my sports trainer just mentioned it. I thought, you only know me for 2 weeks and you already called me Lukey, so that's kind of no. I mean, I think in Australia it's really a thing. Everything gets a Y behind it. Even the barbecue was called Barbie, so maybe you should change your barbecue grilling session name. But the
CEO Barbie. But then I don't get to interview any female CEOs because they would feel offended. Let's when we talk about who's more geology oriented essentially on the management team and the people running these companies is more or less what's been the topic here for the last couple of minutes. But so where do you see that stronger market reaction to discoveries? Is it so that, because what happens really in Canada right now, and Luke and I have talked about that in previous episodes, is but the only thing that seems to move stock prices substantially is a new discovery, and it oftentimes has to be greenfield discovery. So you drill something that's above 100 gram meters. That's kind of the thing that people look out for. Do Australian stocks still get a nice reaction to a discovery, even if it's not that 100 gram meters? Like if it's what people call geological success, would there still be a reaction to the stock price?
Depending on circumstances, yes. I mean, right now, because gold's so hot, anybody drilling a gold hit in Australia, even if it's dubious, gets an instant market kick. Whether it hangs around or not, who knows? But right now in the last couple of weeks, I've seen companies reporting, just average hits, and some companies deliberately drilling down things with direct to special holes to make things look as good as possible, and they're getting 50%, 60% re-rates instantly. The market for gold hits at the moment is just not very discerning, but that's only short term. It's the quality ones that endure. So on the Australian scene, De Grey Mining with their Hemi discovery, which is 10 million ounces now, has been a bit of a market darling and been re-rated. Spartan Resources, who took over a failed mine and instantly found a high-grade thing directly underneath the pit, have been really well rewarded in the market. So the market's pretty smart. It recognises what is true quality, and so there's a big difference between a junior getting a 2 week long 50% kick that comes back down to earth versus those guys who are Spartan's probably well over $2 billion, maybe $3 now market cap, and they haven't finished really growing their resource. De Grey, they're subject to a takeover by Northern Star, and again, they haven't even got their permits yet. So the market recognises quality for sure.
Wait, and you're familiar with the Lassonde curve or the Lassonde curve? You're familiar with? Is it different in Australia, where it's you get the largest reaction you get to discovery, they go to resource, PA drops a little bit off. Would it be different in Australia?
No, it's exactly the same. The as soon as the market senses that initial re-rate is over, and you're going to be spending 2 or 3 years doing feasibility studies and ultimately needing finance, then there's no short-term benefit for staying in the stock. Hence that orphan period, I guess. But even without a discovery, I've found in Australian stocks, companies chasing porphyries, for example, will suffer from that because they'll get a good hit, but it's actually penalised by the market sometimes, because the market just then thinks, oh, you're going to have to drill a shitload more holes into this thing, and so you're going to need a load more money. So we're out of here for the time being. We'll come back later on. So, small companies chasing big targets can actually suffer even in the event of success in that regard. There's a lot of hot money that moves around, and as soon as I think the market sense that the momentum has gone from a particular stock, it'll go somewhere else. And there are a few companies around with decent resources, but they're just perceived as being too big a bite for that particular company.
Well, why I'm asking that is because I'm wondering who's who's more speculative. Is it so that Canadians like early stage better than Australians, or vice versa? Is it more typical for an Australian institution? Because that's something we didn't talk too much about, but you guys have way more institutions that do actually go into natural resources and exploration as well. So would you say Canadians are more speculative than Australians?
Yeah, I would. And at the risk of not pleasing some people, I think there are a lot more cowboys as well. It's you go to Vancouver and you want to check the fingers on your hand after you've shaken hands with some people. So I think also in some regards, when there's a good news story in Canada, people jump on it and they tend to be less discerning, whereas I think the investors in Australia are much more technically focused and need a bit more convincing in that regard.
Is it we discussed a little bit the share structure that's important in Canada, not so much in Australia, but is it also the opposite way when the Australian investors see a 50-cent stock that they get put off because it's not a 2-cent stock? I mean, almost the opposite thing, that they want to have a 1-cent stock to feel like it's cheap.
Yeah. I'm sure. Yeah, there's some weird, incorrect psychology at play there. Absolutely. The other thing is some people will say, oh, it's great to have a penny stock because it can only move by 0.1 cent increments, so you're going to make 10% gains on just one tick. But then there's less volume or whatever. So it's all in the mind.
I think Canada moves half a cent increments, right, Luke?
Depending on the price, from 45 cents, I think it goes into 1 cent. I think it's around 40 cents. That's when it goes from half a cent to a cent.
Okay. Because that's kind of funny when you have a half a cent stock, which nobody should ever. But if you do have a half a cent stock and it moves to 1 cent, then you've made a 100% profit. The only thing is that you can never sell because there's no buyers. There's no volume. In Canada, there's just very little volume on these small cap names. Do you guys get more volume? That's something I could have checked for myself, but does Australia generally get more volume than Canada?
Based on my personal experience, yes. I'm invested in Australian companies and Canadian companies, and it's really hard to buy or sell on market in Canada compared to Australia. Absolutely. There's very little volume.
Yeah, I've done the comparison. I think sometimes it's almost 3 to 4 times factor. And of course, there's bigger factors as well. But on average, it's about 3 to 4 times. So like a $10 million company would trade $10,000 a day or maybe $15,000 a day in Canada. And it would do 50,000, 60,000 for like a non-promotional or not hot story. Hot stories are maybe even bigger factors. Then you see $1 million of volume where you only have $50,000 or maybe $100,000 a day in Canada. So it's a really big difference. But I guess there's also a little bit of a difference in market depth, right? Even though the North American markets are really deep, especially the US one, I think the money available to speculation is more in Australia compared to the Canadian markets right now.
Yeah,
Well,
I think there's a double whammy, as we say in Australia, actually. So, I think the Australian market is smaller, so there are fewer names to invest in, and therefore there's more money seeking fewer places. But then there's also, superannuation and stuff like that in Australia, which is a factor too. Everybody pays, I think it's 12% of their income these days into a superannuation fund, and those funds have to invest that money. They will generally go for the bigger guys and the blue chip companies, but as they become fully invested in those, they have to move down the food chain. And a lot of superannuation funds or the investment funds that the super funds are invested in are investing in smaller and smaller companies. So there's more money and fewer homes for it. So I think that's the difference.
I think no, go ahead.
And yeah, so when you do get a discovery, and perversely, if it's in a poor market, that discovery really gets attention. And if you get a discovery in a poor market, it tends to go better than a discovery in a good market because there's just nowhere else for that money to go.
What about private companies? Do you see private companies drill? Do drill programs, or is it really are companies going from private to public very quickly in Australia? So you form a company and you go public very quickly.
Most of the time, 95% of the time, you go public as soon as you can, because you can spend a lot of money quickly drilling holes, and most people prefer to spend other people's money rather than their own. There's the odd company. Odd companies will try and drill and add value, and with the intent to, list as a bigger entity. But the trouble is you can tend to get overvalued, and there's less meat left on the bone for incoming investors at that point. So, there's one or two people who explore privately, but it's by far the exception.
Yeah, with private, I'm not just referring to one or two persons funding things, but in Canada, you also have companies staying private, but raising money from investors, but just not listing yet.
Yeah, no, there's some, there's in Australia, the sort of way it works, you have private companies with less than a certain number of shareholders. You have public unlisted companies and then you have the public listed companies. So that there are public listed companies with, companies with 50 to 100 shareholders maybe, who are funding it themselves, and there's no open market for it. But again, there's very few of those. And a couple of examples I do know of, when they have listed, they've actually gone backwards because the initial investors put so much of their own money into it, and they get fixated on what the value should be, and there's a mismatch between that and what the market recognizes.
Is that because are companies maybe quicker to list in Australia because there's that ASX-premium? I mean, that's something that we hear, or that I hear at least, is like, oh, if this discovery was in Australia, it'd be 100 million market cap. Now, because it's in Canada, it's 25. Do you think that's a thing? Like, is there an ASX-premium?
These days, yeah, I do. It used to be the opposite. 20 years ago, you'd have Australian companies wanting to dual list in Canada because there was a Canadian premium. But I think it's completely flipped now. Generally, partly because of the general terrible state of the market in Canada, but I think partly because of those sort of dynamics we talked about, in that it's a smaller pond with more money needing places to invest. So if you do have a decent asset of some sort, it'll get more recognised in Australia than it will in Canada right now. And, just today, Robex disclosed it's intending to migrate from TSX to ASX and list.
Yeah. Does that make sense? Dual listing. I think you've been involved with it. I don't think you were the CEO, but you've been involved in a dual listed company. Does that make more sense? Do you get more capital, or do you just get more headaches?
More headaches, definitely. You've got double the compliance fees and listing fees and everything else, and you've got regulatory regimes which are similar enough to con you into thinking they're the same, but there are enough differences to really cause you a lot of grief. So yeah, I'm not in favour of dual listings. It's a pain in the ass.
There's a point that we can talk about the regulators and the NI 43-101 versus JORC and stuff like that. But I'm also thinking about that premium on the ASX. Could it have something to do with the Chinese? Meaning, if you have a large copper project listed in Canada, domicile in Canada, but the project somewhere in whatever. I mean, we've seen with lithium projects in South America, the Canadian government won't let the Chinese buy it off of you. Does that happen in Australia? Like, can Australians just freely sell their South American projects to the Chinese?
There's what's called a Foreign Investment Review Board that evaluates all of those cross-border transactions, and if that deems it's not in the national interest or anti-competitive, it'll disallow it. So you can't just freely sell what you want to who you want in that regard.
Yeah. Do you see it happen? Like, does it? Has the government blocked a Chinese deal or a non-West friendly deal?
Yeah, okay. Yeah, absolutely. Yeah, and I think it's becoming more commonplace with the geopolitical stuff happening right now. People are starting to think twice about all sorts of things. And there are a few events that have happened in Australia that are nothing to do with resources that have sort of probably focused people's attention on that sort of stuff, like the Northern Territory, one of the states of Australia, leased the port of Darwin, the capital city, to China for, I think, 99 years. And at the time, nobody seemed to notice or care. But now in this new environment, people are just absolutely gobsmacked that could even happen. And resources are sort of starting to get viewed in the same way as well, I think.
I actually didn't know. That's an interesting factoid there. How is it that regulators behave differently in practice? Is it do you see regulators getting more involved when something goes wrong, like an insider filing is late, or an NI 43-101 or a JORC in your case is not exactly up to par? Do you see the Australian regulators getting more involved than the Canadians, or is there no difference?
Yeah, I can only speak from my personal experience, but I've found a huge difference actually. The Australian Security and Investments Commission, that is the sort of watchdog of the market, if you like, together with the ASX, police things really closely, and they're very, very thorough and strict in all sorts of ways compared to my experiences in Canada. There was an example today of a company that had put out a scoping study and they'd included a stockpile that had 4,000 ounces of gold in, which was just a trivial amount. But the ASX made them go into a trading halt for 2 or 3 days until they could rejig everything and put out a retraction on that, all for that 4,000 ounces in the stockpile. So that's how rigorous they are.
You also halt for financings, I think, right?
Yeah, halts for Oh, yeah. Yeah, when I first realised that there were financings live in Canada and the market was open, I'd never seen that before. It makes
no sense, because sometimes you do financing at $1 or whatever, and then your stock's going to fall to 70 cents, and it didn't make sense. It still does make sense to me.
And the opposite, yeah. I think, when you get big names involved, you see the price go up the day before, and then the announcement comes out the day after. But what about price queries and volume queries? You see, when stocks move without real news, you get this price query from the exchange. And I always read these questions and they always get answered. I mean, the ones that I've looked at in the same way, like either there's no material news or there was, but we were negotiating, whatever, and then they explain all the different steps that happened with all the dates. So they really have to explain what they did during those days. I mean, is there a consequence when there's no good answer, or do you typically get away with any answer for these volume and price queries?
There's not always a consequence in terms of legal action or, sanctions of some sort on the company. But I guess reputational damage ensues. So, there's that sort of sorting hat of the companies who do things properly and the ones who sail a bit close to the wind. And they may not get any direct legal consequence, but it does affect investor confidence in those companies for sure. And when you look at the answers to those queries, you can tell they're written by lawyers because they're completely non-committal and they're completely bland. We S2's had queries from the ASX, some crazy ones.
What did you do?
Yeah. Oh, we had a query once, basically that they said, there's no description on how you treat your diamond core in the tables at the end of the report. And we said no, because they're RC holes. There is no core. So, they're very officious and overly efficient sometimes, and they're very, 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 keen on sticking to the true meaning of continuous disclosure. I know a story of one company. The CEO was called by the ASX because 10 to 4, 10 minutes before market close, he'd been in receipt of material information. So they put out an announcement pre-open the next day, and he was called to task why they didn't go into a trading halt for the last 10 minutes of the previous day.
Luke, what did you mean by that question actually? Because does it mean that in Canada, like if the regulators call you up in Canada, you can just tell them anything? Like they're like, well, why is the volume 10 times as higher? And you're like, well, the tides are different and the standing of the moon today kind of is causing investors to be more emotional. Like, is that what happens in Canada?
I don't think you get many of these queries quick, or you have to have a really extreme price move. So I don't think there's as much policing there. I still see also in Australian markets that when there's really good news, sometimes you see a bit of volume or the price going up a little bit. I do remember, by the way, that Sirius, which was a 100 bagger, did not go up a cent, I think, before the discovery. So well done on that part. You almost never see that. Almost never. I mean, in Australia too, you see a little bit of a price increase. And of course, there's always a reason, a legitimate reason. And I always think, of course, but of course, you can never prove it. In most cases, you see a bit of volume increase. But I think in Canadian markets, you see it prior to a good financing. You see it prior to a discovery. You see it almost always with good news, and not so much in Australia, I think. And because there's a formal, price query in Australia, I read these things, and I was just wondering, how serious these documents are taken by the company and by the exchange, and if there was any follow-up, because I never really asked the company about it. So for sure, there's a bigger focus on these things.
You mean like leaks? So you mean that the chance is higher for stuff to leak in Canada than in
Yeah, well, the Australians, I think, are, as far as I can see, but I'm asking the question because I'm not too active over there. They seem to be way more protective, trying to avoid leaks. And if there's a leak, then immediately get a formal document towards the issuer asking what happened. Then the issuer has to answer like, why did the stock go up without news? And so they really have to formally answer that, and then also release those answers to the public. You don't see that in the Canadian markets.
Yeah, I think trading halts are more common in Australia, and the purpose of the trading halt is to avoid an uninformed market. So people tend to do what they're supposed to, which is going to a trading halt if there's any ambiguity or risk of material information sort of escaping. Now, some people play that. Some people use trading halts as just a means of drawing attention to themselves before they release good results. So it can be abused as well. But I think overall, there's more adherence to that in Australia than in Canada. And I had an instance once and I'll be very careful about not sort of saying too much about where or when, so I don't give any secrets away. But there was a company we were aware of that were our neighbours actually, and they put out a TSX-V announcement of a discovery, and it showed the guys standing there on the outcrop. And this announcement was in February, and it was about somewhere from a very high latitude, which would have been covered in snow at that time. And I thought, hang on, this photo of this discovery must have been taken last summer, not last week. So they've been sitting on this information for 6 months, and we actually submitted a complaint to the TSX-V compliance department. And the TSX-V compliance department just sort of shrugged its shoulders and sort of said, so what?
Yeah, I think there's a big difference for sure. But in terms of like when you drill, I mean, when you are drilling in the field and in certain systems, the core will tell you, I mean, I think the core will always tell you something, but maybe in gold, not always the grade, and with other types of systems like these massive sulfides, you would see when it's good and when it's bad. I mean, how do you deal with it? Because typically you have to go with your core to the core shed and then start doing all the logging and all the work you have to do, and then you have to send it to the assay lab, and then there's people doing things. You're not going into a trading halt for 2 months. So how are you protecting that knowledge?
Yeah, there's no sort of bulletproof way of protecting that, but you can sort of put in place as many systems as you can to try and minimize that risk. So, you know, every driller has to sign a non-disclosure agreement and so on. The drilling contractors are subject to various contractual clauses that can penalise them should that happen. Same with the labs. In terms of employees, they're all sort of operating under company policies that can be, you know, punitive should they do something dodgy. And sure, there's always risk of something happening, but by and large, it doesn't. So it works pretty well. And, you know, these days, it's even more important because, you know, most drill rigs have digital cameras and satellite phones. So they're pretty well connected to whoever they want to be in real time. So yeah, I guess the legislation forces the companies to impose these frameworks to police themselves, and by and large, it works.
But that must be like all if you have a big discovery. I guess the one with Sirius in 2012 was one where you saw the core and you knew this is we have something. I mean, there must be at least 10 people, maybe 20 at some point, that are in the know about it, because you have people, you know, trucking it, looking at it, splitting the core, assaying the core. I mean, at some point you have 10, 15 people, and you're looking at a $5 million company. So it must be still quite hard for people not to call their uncle or something.
Yeah, absolutely. And you know, it does happen. I'm sort of speaking in generalities, but it does happen. And again, there's a spread of companies that are responsible and not. But it's just sort of ironic that Australia, which was founded on basically exporting criminals, seems to be more honest.
That's right.
Do you think it's got something to do with NI 4311 versus JORC though? Because you guys have something that's called and I recently learned that, but something called an exploration target, where you go out as a company and you say, we think this thing could get that big or like within a range, which is something I ask Canadians about in interviews as well. And they're always like, oh, like, what are you asking? We've got absolutely no idea how big this thing could get. So maybe tell me more about that exploration target size thing, and if you think that influences the market.
Yeah, I think it does. Well, it influences sectors of the market. It influences retail more than institutional who've been there, done that.
Mm-hmm.
I'm not a fan of that personally, because again, I think it gets gamed a bit. And you can, you know, put out an exploration target, and it makes it seem more real, whereas in fact it may not be real at all. And the way it's enforced is you can't say, we've got an exploration target of 3 million ounces of gold or whatever. You have to have a specific tonnage at a specific grade to come up with that metal content. And by doing that, it looks more real. It's sort of precise but inaccurate. So to me, I don't like that.
That's interesting. That sounds kind of like me, precise but often inaccurate most of the time. What is we've talked about a lot of the positives actually of Australia versus Canada. What do you think what's kind of the worst thing about the Aussie markets? If you had a magic stick, you could wave it, you can make something go away. What would you wave it at?
Oh, shareholders.
That's because I'm not there.
I think the worst thing about the Aussie market is the degree of policing tends to focus on trivial things, and sometimes bigger things slip through the cracks. So you're dealing with a lot of vexatious things that you feel are unfair. And ASIC and the ASX don't always get it right. Like a couple of years ago, they came out with a new policy that basically said, you can no longer put out an announcement describing the results of a scoping study, because that might be a means to encourage somebody to invest. And the rest of the world said, well, that's the whole bloody point.
Yeah.
They ended up backing down, but they just sometimes come out with these crazy ideas that aren't fully thought through by people who aren't necessarily experienced in the industry. The fallback from that position in that case was, oh well, it's okay if you've got a proven management team who have built mines before, then you can talk about it. And we said, well, hang on, what if you're a first timer like Sirius was? We haven't built mines before. So there's vexatious things like that. I do wish there was, I think the worst thing about the Australian market compared to the Canadian market is in a resource sense, there are fewer opportunities. I still feel that Canada has a lot more unexplored territory where you can just walk up and bang a rock and find something interesting than you can in Australia. So I prefer Canada in that sense, but that's more intrinsically about the geology of Canada than the markets or whatever.
Yeah, when you we discussed the market valuations and the interest from investors and the volumes available, but also I think from a cost point of view, I think you mentioned in Antonio's interview last time that conferences are more expensive. And I was thinking that conferences on the Canadian side, or at least the Canadian markets, even the European conferences, are pretty expensive for juniors. And my own experience is that I'm buying some data from the ASX to publish, and that's way more expensive than the Canadian data. The exchange is just asking for a lot of money to just release some simple data. Are the costs in general higher? Is that for promotional service like conferences, for example, or maybe even drillers? Is everything more expensive over there? Is that a downside?
Across the board, yeah, absolutely. So, conferences are more expensive, and there's a whole sort of sub-industry of conference providers, and it almost becomes like a self-help club, seeing the same people in the different place every month. But, costs in mining are higher. So, there's a lot of people lamenting the demise of the West Australian nickel industry at the moment and blaming the nickel price for it. But the nickel price is actually higher than it was when we started Nova. It's not the nickel price that's the problem, it's the cost base. Labour costs have gone up. Capital costs have gone up because, when you build a mine, even though it's called CapEx, probably 60 or 70% of the dollars in that CapEx is the people who put the nuts and bolts together. So, labour is really expensive. Yeah, and that's reflected in drilling rates, everything else as well. It was cheaper for us to drill 200 k's north of the Arctic Circle in Finland than it is for us to drill 100 k's north of Melbourne.
To the topic of promotional services and activities there, that's also an interesting one because you said that sometimes the regulators will frown upon a scoping study. What about promotion? Are there strict rules and regulations about what you can do and say in interviews or at conferences? And are there, like, newsletter writer promotion is very popular in Canada, where they would pay someone to say good stuff about the company. Does that happen in Australia? And how does promotion over in general work?
Yeah, much less so in Australia. There's fewer of those newsletter writers. If any of note, really. So yeah, it's just not in the DNA. There's, companies in a way rely on analysts in broker firms to say stuff about them that they can't say themselves. But it tends to be those analysts. So it depends if you have an affiliation with a particular broker or not. There's a few sort of really rinky-dink video producers, but I find that there's hardly any audience for those. They'll get watched by about by the CEO's family and friends, and that's about it. So it's vastly different like that. So yeah, in terms of what you can and can't say, I don't think it makes much of a difference. But there's just not much of an industry like that here, and what exists just doesn't have much of an audience. I think most of the investment community goes directly to the sort of ASX platform to look at announcements and releases rather than rely on intermediaries.
That's interesting because the business model of this channel is charging issuers for interviews, and they get no questions up front. They don't get to dictate the tempo. Like they don't get to send me a list of questions or to ask me not to ask stuff. So they get no questions off the table, which does happen, believe you me. They get no editing rights and stuff like that. And that is still very strange for a lot of issuers. Like there would be companies that, the interview show that I do, as you would remember because you were on it, is called the CEO Barbecues, because it's meant to grill the CEO, if you will. And it's mostly an effort to try and be funnier than I really am. But the point is, there's companies that would expect, like, okay, if we pay for an interview, then it's no longer a CEO barbecue. So you're not actually going to ask us the questions. You're going to suggest or promote our company, essentially. And that's not something we do. I mean, it's not something that I don't put out suggestions saying, oh, you should buy this stock or anything like that. It's just really, you get an interview and it's a fair interview. Whereas, and so not a lot of companies like that strategy because they are used to, in Canada, they're used to, you pay a newsletter writer, he's just going to write the good stuff about you and that's it. So it sounds like my business might do better in Australia. I might have to relocate.
Well, funnily enough, and I'm not being sycophantic here, but the thing I found different about both of you guys is you sort of say that as it is more. The things you do get in Australia are really bland, and they're dumb questions asked by people who don't really know what they're talking about, and you just feel bored watching them. And they're only like generally 2 or 3 minute clips, but it's just like 2 or 3 minutes of your life that you've lost that you'll never get back. So to me, yeah, there's value in this sort of stuff because it might not be comfortable, but it's real.
Well, thank you for saying that. I appreciate it. This is actually a good note maybe to end it on while we're still friends. But I really do appreciate your time here. Anything else that we're forgetting to ask you? Anything that you think is important to talk about ASX versus TSX that we are forgetting to bring up?
Oh, look, just a couple of things quickly. I think one bugbear of mine is, and we've faced it because we've been in joint ventures with TSX-V listed partners, the difference in reporting sort of process and style. In Australia, we'll put out announcements which are full of figures and information and stuff like that help you understand everything you're talking about in one spot. Whereas in Canada, you get these text-only sort of releases that refer you onto other reports and stuff, and the dreaded CDAR platform, which makes it really difficult to really get into the detail easily. So I find that a big difference. And probably the final thing, sort of tongue in cheek, is the main thing I noticed about, and you know, Australia is funny because Perth in the west and Melbourne and Sydney in the east are just like Vancouver versus Toronto in Canada. The western bit is the sort of looser and faster bit, if you like. But you know, when my first few times in Vancouver, I was really sort of confused because I'd meet people, these guys, and they were wearing really bloody smart suits and were very confident and you know, saying how good this, that, and everything was that they had, and I'd feel completely inadequate. And then what I realised over time was basically, you know, Vancouver, the guys really, really over promote, and there might not be much substance behind the style often, and they tend to exaggerate everything because that they assume that's what you have to do to compete. Whereas Australians are the opposite. They tend to be a bit self-effacing and be a bit more sort of modest in the way and understated in the way they say things. So when an Australian meets someone from Vancouver, the Vancouver guy will be saying, "I've got something and it's this big," when it's actually this big, and the Australian guy will be saying, "I've got something this big and it's actually this big." But the Vancouver guy will be assuming the Australian guy's exaggerating, so it's even worse.
It's actually, it's something that I've been thinking about. Like, why is that the case? Like, is it weather? Is it because of the tides or something that the Western coast is more? Again, we're talking about the moon here. We might as well start doing technical analysis at this point. But something that I've been thinking about is what's really causing it, and they're both far away. Like Perth and Vancouver, they're far away from the country's financial centers, right? So they're both far away from Toronto. Maybe and they're also, Vancouver is much more about mining than Toronto is. I mean, you go to Toronto, I think, as far as I've heard, I've actually never been to Vancouver. I've only been to Toronto, but in Toronto, people don't necessarily talk about mining. Whereas like, and Luke, you've been to Vancouver, so you might be better off telling this story. But when you go to a cafe or whatever, people are talking about mining kind of on the street. So maybe it creates more of an echo chamber. Yeah, I don't know what it is, but I've noticed that as well.
Yeah, probably. I think, I mean, if you just approach someone in Vancouver, they will not talk about mining typically, but there are more people into the speculation part. And for sure, it's a small world. So you will always see someone who's involved in the mining business, and Toronto is just a way bigger city. At least that's how I experience the cities. And indeed, then mining is a small thing. And nobody talks about mining is the impression. So yeah, I think I agree. I like Perth as a city a lot, and I've never been there for the purpose of mining or investments, but I can imagine that it's small enough, like Vancouver. It's a big city, but it still feels a little bit like a town in a way. And maybe it's you have these spots where all the promoters come together and tell each other big stories.
Absolutely, yeah, it's true. And so just you know, my first meeting in Sydney after Sirius found Nova, I had a lunch with 12 fund managers, and I gave the presentation, and then there was this silent pause afterwards. And one guy says, "You're from Perth, aren't you?" I said, "Yeah." I said, "But you don't appear to be lying."
Well,
similar sort of situation. You know, Melbourne and Sydney are the financial centres, and they're much more diverse economies, and mining's less important. Whereas it's a small town in Perth, and it's all about mining, and there's a lot of people who've made a lot of money from it.
Yeah. I think your dogs are getting tired of listening to us. One is actually coming to be like, "Mark, lose these two losers and come and walk us." We'll let you do that. Thank you so much, Mark, for doing this. I really appreciate it. It was a great conversation.
Thank you, Mark.
Yeah, no problem. All right. Cheers.
And thank you to everyone for listening and watching. This was an interesting conversation. Any and all questions for future interviews are, of course, welcome. Please post them in the comments. But I am still going to kind of repeat the warning that I said at the beginning, that everything, everything combined with the warning that I gave you at the beginning is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be some type of bias in what everyone tells you online. They may own shares of the company, they may be a director, they may have been paid by the company, and so on and so forth. Now, this entertainment program specifically is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. Losing money is the norm and should be the expectation, as this is a very complex sector, and the performance of individual companies typically depends on many different things, including geopolitics, macroeconomics, commodity prices, and many other moving particles that are typically outside of anybody's control, and no one can really foresee them, because unfortunately, and believe me, I have tried and I might even keep trying, though I doubt I'll ever be successful. I just don't possess any superior knowledge about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sorts, as this was a conversation that was general and impersonal in nature between a couple of individuals, none of whom are your licensed financial advisor and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So please talk to a professional licensed investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.com, where you'll find the official filings of the companies that might have been discussed in here today. And if you don't do that, you're highly likely to lose your money. There's a couple of documents that are absolutely obligatory reading for people interested in the space. And that is, of course, the MD&A, which is the Management Discussion and Analysis. And it's an official document that the company publishes on setterplus.ca. You want to look at the financial statements of any company and understand how and why and where they spend money. And you also want to look at the Management Information Circular, which is going to tell you how much money each insider of a company earns in total compensation, bonuses, and everything, and all the other incentives that they might have. It's also going to show you if there are any change of control fees and whatnot. It's a very important document. And then, of course, this is a technically focused business. So you also want to read the NI 43-101 technical disclosure. And again, if you don't understand it, consult with someone who does understand these things. Because if you don't do that, you are highly likely to lose your money. So yes, thank you so much for listening to this. And I'll leave you with one of my favorite Charlie Munger quotes, which was, if you don't understand it, don't do it.